What is the hidden impact of offshore accounts on wealth statistics? Imagine trying to see the full picture of wealth in the United States and realizing some pieces are missing. Offshore accounts are one of those hidden pieces that can make the picture look different than it really is. Many wealthy Americans keep money in foreign accounts, especially in places known as tax havens. These are countries or territories with low or no taxes and strict secrecy laws. Experts estimate that Americans hold about $4 trillion in these foreign accounts. Nearly half of that is in tax havens, which makes it easier for the wealthy to hide their assets. Most of this hidden wealth is owned by the very richest Americans. In fact, over 60% of the top 0.01% of income earners have offshore accounts. They often use complex structures like partnerships or shell companies to keep their ownership secret. Because of this, the true amount of wealth held by the ultra-rich is much higher than what official data shows. When wealth surveys and tax records are compiled, they do not include these offshore assets. This means the official figures underestimate how much the richest households actually own. This hidden wealth impacts how we understand wealth inequality in the country. Since the data does not account for offshore accounts, it makes the gap between the very rich and everyone else look smaller than it really is. The wealthiest individuals are more likely to have these secret accounts, so their true financial power is not fully reflected in public statistics. This can lead policymakers to underestimate the severity of economic inequality and make decisions based on incomplete information. Tax authorities, like the Internal Revenue Service, try to uncover offshore accounts through laws such as the Foreign Account Tax Compliance Act. This law requires foreign financial institutions to report accounts held by U.S. taxpayers. Thanks to these efforts, about $100 billion in offshore assets have been disclosed so far. But despite these measures, a lot of offshore wealth remains hidden. This means the government loses out on billions of dollars in tax revenue each year, mostly from the wealthiest taxpayers who do not fully report their assets. The loss of tax revenue from hidden offshore accounts shifts the tax burden onto less wealthy taxpayers. Since the wealthy can often avoid paying their fair share, the gap in economic resources grows wider. This also makes it harder for the government to fund social programs or public services that benefit everyone. When the true extent of wealth concentration is hidden, it becomes more difficult to design fair policies that address income inequality. From a broader perspective, offshore accounts make it harder to accurately analyze the distribution of wealth and income in the country. They mask the real level of wealth held by the richest households and distort socioeconomic indicators. This can lead to underestimating the degree of social and economic stratification. It also complicates efforts to promote economic mobility or create policies aimed at reducing inequality. In summary, offshore accounts create a hidden layer of wealth that skews the official picture of wealth distribution in the United States. They hide assets owned by the wealthiest individuals, leading to underreported inequality and lost tax revenue. This makes it more challenging for policymakers to understand the true state of economic disparity and to develop strategies to address it.